Okay, so we're live. Hi, more people are joining in. Hi, everyone. Just a second, I'll switch on my video. Hi, everyone. I'm Pranay Kedia from Jadavpur University Entrepreneurship Cell. We have with us Brian Feroldi joining in from the United States. Brian is a contract writer for the Motley Fools, a YouTuber, and a celebrity of FinTwit of some sorts. Brian's mission is to spread financial awareness, and he's doing everything in his capability to fulfill his mission, I feel. There are a number of resources he gives out in a pay-as-you-like model. These include a daily long-term mindset newsletter, a comprehensive investment checklist, and the best of all, his YouTube channel. I'll stop now and let Brian take over. Before that, some rules for this session. Please do not unmute yourself. If you have any questions, send it to me via Zoom's chat, and I'll direct those questions to Brian. That's all from me. We'll just wait. I'll play a small video, and after that, we can start. Just give me a second.
We would have loved to host you in our campus, Brian, but since it looks like something very unthoughtful right now, so we will just be heading out with a virtual campus tour of us.
I'm waking up, I'm feeling in my bones to make my system work. Welcome to the new way, to the new way. Welcome to the new way, to the new way. Radioactive, radioactive.
Yeah, Pranay, you can go on now.
Yeah, Brian, you can take over and let's start with the session.
Okay, I'm coming up. Viewed okay? The tech is working? Awesome.
Everything's
Thank
fine.
you. Great. Thank you all so much for having me. I absolutely relish the opportunity to talk to young people about my favorite topic, which is money and investing. So my hope is in the next half hour or so, I will answer the question that I had when I was brand new to the stock market. Why does it go up? I think everybody here has seen that long-term wonderful chart of the S&P 500 or the stock market in general going up. And if you're anything you're like me, you'd be like, well, why? That doesn't make any sense. Everything I've ever been taught is that what goes up must come down. How come there's this thing out there that just goes up? It doesn't make any sense. So I hope by the end of this, you'll have a better understanding of why that is. All right. So before we talk about why the stock market goes up, let's talk about this. Why the heck should you care about the stock market? Isn't that just numbers on a screen going up and down? Or years ago, wasn't it just numbers in the newspaper moving? Who cares? Boring, right? Well, I think it's best to showcase you why you should care about this by using a fictional example. Meet Aaron. Aaron's a character I made up, and Aaron is a normal United States citizen. Aaron's career started in 1981, so about 40 years ago. Aaron was a typical American worker. Throughout his entire career, he earned an average salary, completely average in every way. And also being completely average in every way, Aaron lived paycheck to paycheck. Money came into his account, money left his account. He was terrible at saving. He was terrible at budgeting. He didn't know anything about investing or the stock market or anything like that. This is a very typical story in America. But Aaron made one great decision in his life. When he joined his company in 1981, there was this new thing called a 401k. Now, for those of you that are unfamiliar, in the United States, we have this tax advantaged savings vehicle called a 401k. And Aaron, not knowing what he was doing, signed up for it. And he put $400 per month into his 401k. Now, that's a lot of money in absolute terms, completely. However, that is for most people in the United States an affordable amount of money. And importantly, that number automatically went into the stock market. It came out before he could get his hands on it. Now, Aaron, again, knew nothing about the stock market, nothing about investing. When he got his brokerage statements in the mail, he threw them out. He didn't know how to read them. He didn't know what the numbers meant. He completely forgot that he signed up for this thing. Now, Aaron's career was unspectacular. And 40 years later, Aaron decided to retire. So this was 2020. Aaron said, I've had enough. I've been working for 40 years. It's time for me to retire. So the question is, how much money was in Aaron's 401k in this account at the end of 2020? 40 years of investing in the US stock market, $400 per month. Well, the answer is $3.01 million. $3 million. Not bad for someone that really only made one good financial decision in their entire life. Now, if you're good at math, you might be saying, hang on a second, $400 a month times 12 months per year times 40 years. That ain't 3 million. That's only 192,000. Now that's a good chunk of change, but that's nowhere in the ballpark of 3 million. Where did that difference come from? How did 191,000 turn into 3 million? The answer is the stock market. That is the power of the stock market. The stock market enables ordinary people with ordinary incomes to build extraordinary wealth in their lifetime. And if you look at the long-term chart of what Aaron did, that blue line at the bottom, that's how much Aaron saved. That's his cumulative savings. That red line on the top, that's his net worth. And that's how you can see how the stock market drove that number higher and higher and higher over time. Now, is this an extreme example? Yes, this is fictional, but this doesn't happen in the real world, does it? Well, there's plenty of examples of this happening in the real world. And not a year goes by that you hear a story like this. There's a secretary named Sylvia Bloom in the United States. She was a secretary. She was a widow. She earned a secretary's salary her entire career. When she died, she left $8.2 million to charity. How is that possible? How can a secretary leave $8 million to charity? Or how about Leonard Gagowski, who was a grocery clerk? He was a grocery bagger. He left $13 million to charity. Or Margaret Southern, a special needs teacher, $8 million to charity. Ronald Reed, a gas station attendant, $8 million to charity. How did these ordinary people with these average to below average incomes amass millions of dollars? The answer is they live below their means and they invested. That's it. That's it. That's why I absolutely love talking about and teaching people about the stock market. Now, if your spidey senses are going off, you might be saying, hang on, 1980 to 2020, that sounds like cherry-picked data. Cherry-picked. Was that a fluke? Did the stock market just do extraordinarily well for that specific 40-year time period? Well, there's no doubt that the stock market did really well for that time period. But if you look back at 200 years of data, you'll see that stocks have consistently outperformed all other asset classes. This data on this chart here is from 1802 to 2002, 200 years of stock market data. If you invested $1 in the stock market, in the US stock market in 1802, that single dollar was worth $705,000 in 2002. And that's in real terms. That's after subtracting for inflation. Stocks, the stock market, has gone up and produced real wealth creation of about 6.5% per year after inflation. If you don't account for inflation, that number is closer to 10% per year. So I hope I have you interested in learning about this magical thing that turns little bits of money into lots of money. But let's back up a little bit. What the heck is a stock? What does that mean? We throw that term around as if people just know. A stock is just fractional ownership of a corporation. That's all it is. Stocks are used to help people track who owns what in regards to a corporation. They're just fractional ownership. So take a company that's extremely well known globally, Apple. Apple is a publicly traded company, which means the company is literally owned by the public. Apple has billions of shares outstanding, and each one of those shares represents a fractional ownership of Apple, the company. And those shares are simply owned by regular investors, individual investors, pension funds, mutual funds, people that have capital invested. That's the people that own Apple. And they track how much they own by the number of shares that they own. Now, importantly, companies can choose how many shares they have. This is a completely made up number. It's made up by each company. So in Apple's case, Apple has 17 billion shares. That's the number that Apple chose right as of right now. There's 17 billion shares. So if you own one share of Apple, you own 1/17 billionth of Apple. Now, Microsoft has about 8 billion shares. Uber has about 2 billion shares. These numbers are completely made up by the companies themselves. They can divide themselves into as many shares as they want to. Now, why do these things called stocks have value? Great. Apple's divided up into a whole bunch of different shares. Why are they worth anything? Why do people pay money for these things? Well, if you own a share of Apple or any company, you have a legal claim on two things. First, it's profits. When that company makes a profit, you have a legal claim on a portion of that profits. Second, you have a legal claim on that company's net worth at time. So in Apple's case, Apple owns retail stores. It has campuses. It has patents and R&D. It has cash in the bank. It has long-term investments. When you buy Apple stock, you, in a very literal sense, have a claim, a legal claim on Apple's profits, both now and into the future, as well as its assets. Now, in Apple's case, if you look back over the last year, Apple generated a profit of $87 billion. That's how much money Apple made after paying all expenses, $87 billion. Now, as a reminder, there's about 17 billion shares outstanding. So for investors to track how much of that profit they own or they have a claim of, we just do simple division. 87 billion divided by 17 billion shares means that for every share of Apple that you own, you've earned $5.15 over the last 12 months. Now, that's important because when a company's profits change, go up or go down, its stock price eventually changes. And if those profits go up, you, the investor, can make a lot of money. So let's rewind and do a quick recap of what's happened at Apple over the last 13 years. In 2008, Apple was primarily an iPod company. That was one of their major revenue sources. But they just launched this new product that holds a lot of potential called the iPhone. Well, that did well. And Apple launched it in more countries, more people purchased it. And then after that, they launched this thing called the iPad. And their profits grew. And after that, they launched Apple TV and Apple Watch. And all the way, all of their products are becoming more and more popular with consumers. More recently, they launched Apple Pay and Apple Arcade. And then the pandemic hit. And this is what's happened to Apple's profits over the last 13 years. They went from 6 billion to 86 billion. That is a massive increase. And that's why this is what happened to the company's stock. The company's stock went up 2,000%. 2,000%. And if you look at these two numbers together, they track each other pretty closely. Yes, there were times when Apple's stock was going down and its profits were going up and vice versa. But over the long term, these two things track each other pretty closely. And if you were smart enough to invest in Apple in 2008, if you invested $1,000 in its stock, today you'd have $21,000. That's why people invest. That's why people buy stocks, because it allows them to take a little bit of money and turn it into a lot of money. Now, we know what a stock is. We know why it has value. What is the stock market? What does that mean? A stock market is a marketplace. It's where people come together to buy, sell, and exchange with each other. It's the exact same thing as like a farmer's market or a supermarket. When you go to the farmer's market, there are people that go there to buy food, and there are businesses that go there to sell food. Stock market's the exact same thing. It's a place where businesses and investors connect with each other to buy, sell, and exchange stocks or ownership of businesses. Now, in the United States, there are two major stock markets, and they're the biggest ones in the world. The first is called the New York Stock Exchange, or the NYSE. The second is called the National Association of Security Dealers, Automated Quotations, which we just call the NASDAQ. Now, in India, those aren't the only two stock markets in the world. There are dozens of stock markets all over the world. And in India, there's two major ones called the Bombay Stock Exchange, or the BSE, and the National Stock Exchange, the NSE. They function exactly the same as every other stock market. They're designed to bring together businesses and investors so they can exchange shares of business of themselves with each other. Now, how do we track what the stock market is doing? In the US, for example, there are thousands of publicly traded companies. And their prices change all the time. How do we find out what a market is doing? Well, there's a shorthand that investors have come up with called stock market indices. One of the major ones in the United States is this thing called the S&P 500. This tracks the price of 500 of the largest and most important companies in the United States. So rather than tracking thousands of companies' price movements, indexes like the S&P 500, like the Dow Jones, like the NASDAQ Composite, track a small subset of those companies and use them as a shorthand for what's happening in the market. Now, this is a typical picture of what happens in the US market, the S&P 500 on any given day. Some companies are up, their stock price is up. Other companies are down. And the net result of that is reported in the news as here's what happened in the S&P 500 today. And that gives investors an idea for what the average stock did in the market on that particular day. And in India, one of the major indices is called the S&P BSE 500, exact same concept. It's taking a subset of companies and using it to figure out what happened in the stock market on any given day, week, month, year, or decades. All right. But why do those stock prices move? You know that they go up and down all day long. Why? What makes them move? Well, there's two primary things that make stock prices move. The first is earnings. Earnings are profits or net income, aka the fruits of those businesses. And the second thing is how much investors are willing to pay for those earnings at any given time. We'll cover both of these in more details, but those are the two things that really matter to stock prices. All right, let's start with profits or earnings. In the United States, again, getting back to the S&P 500, earnings of the companies in the S&P 500 have consistently risen for decades. They consistently go up and to the right. How can that be? Why are company profits moving up and to the right? Well, there's a couple of factors that cause that to happen. The first is productivity. Humans get better at making stuff over time. Thanks to robotics, automation, better skills, better practices, more productive workers, we learn how to make more and more stuff with less and less input. That's productivity. That leads to a rise in profits. Second is inflation. Prices go up over time. The inflation number in the US just came out today, and it was over 5%. That's prices going up. What is inflation? That's businesses raising prices. That leads to profit increases. Number three, innovation. This is new products and new services coming online that open up new market opportunities. Ask yourself, in 1990, what was the market for search engines online? Zero. What is the value of those search engine searches today? Hundreds of billions of dollars. That's a new market that didn't exist 30 years ago that exists today. That's innovation. 4 is global expansion. Companies in the United States and others, after they get to a certain size in their country, they seek out new ways to grow. So they expand geographically. You can currently buy Coca-Cola, for example, which is an American company, in almost every country on earth. That's geographic expansion. And then finally, population. The population of the world is increasing 1% to 2% in any given year. That's adding new consumers to the world. So you add those factors together, and this is why profits rise over time. Now, that's the easy part. Profits go up. Yeah, I get that. How investors value those profits is a whole nother matter. And this is what causes the most confusion. This is why stock prices move up and down so dramatically. I'm going to teach you a very simple concept, which is called the price to earnings ratio. This is when you take the price of an asset and you divide it by its earnings, and that gives you the price to earnings ratio. Real simple example. The simplest business I can possibly think of is a lemonade stand. So I have this lemonade stand, and it does $10,000 in sales in any given year. And to produce that lemonade, all the costs, employees, taxes, etc., is $9,000. So at the end of the year, every year, this business makes $1,000 in profit. And then I ask a question. All right, I want to sell this business. It's going to make $1,000 in profit forever, every year. What would you pay me for it? Most people say, I don't know. But let's just throw out some very simple numbers. So let's say you pay me $1,000 for this business. I agree. You give me $1,000, I hand over this business. Well, congratulations. You bought something for $1,000, and that business is now giving you $1,000 in profits every year. The price to earnings ratio was 1. Well, if you know anything about return on investment, you know that your profit divided by your purchase price is your return on investment. And in this case, $1,000 in profit divided by $1,000 in purchase price is a 100% return on your investment every year. Sounds great to me. So $1,000 is way too low of a purchase price. The buyer got a great deal, but me, the seller, got a terrible deal. Let's try a different price. $1,000 is too low. How about $100,000? Let's go to the other extreme. Well, in that case, the price, $100,000, divided by the profits, 1,000, is 100. The price to earnings ratio was 100. So what is your return on investment now? Well, if you're going to make $1,000 per year and it costs you $100,000, that's a 1% return on investment. 1%. Is that a good deal for the buyer? Would you shell out that kind of money for a 1% return? No, it's a terrible price for the buyer. So let's say the sweet spot is somewhere around a 10% return. That gives the buyer a fair return on an investment, and that gives the seller a fair exit price. So a 10% return would require a $10,000 purchase price. So our $1,000 a year business cost us $10,000 per year. Well, in investing speak, we would say that the PE ratio, the price to earnings ratio of that deal is 10. We paid 10 times earnings for that company. Now, let's take that same business and make things slightly more complex. Instead of earning $1,000 per year, that $1,000 is going to grow 20% per year. So in the first year, we did $1,000. The second year, we did $1,200. The third year, $1,440. The fourth year, $1,728, etc. So it's 5 years later, and our same business is now grown to be doing $2,000 in sales, in profits per year. Well, how much is this lemonade stand worth 5 years from now, after 5 years of growth? Well, if we take that same PE ratio of 10, here's what happens to the value of that company over time. By year 5, our business that you could have bought for $10,000 is now worth $20,000. Why? Because the profits of that business grew over time. The exact same concept applies to the stock market as a whole. As profits grow, the value of the stock market as a whole grows. Now, that was a very simple example that I gave you, where the price to earnings ratio was always 10. It makes figuring out what the business is worth easy. The real world is far more complicated than that. Here is a chart that shows the price to earnings ratio of the S&P 500 over 130 years. As you can see, there are periods when the S&P 500's price to earnings ratio is 20 or 15, or in the 2000s, 30 or 40. Other times, when investors are in a terrible mood, the price to earnings ratio has fallen all the way to 5 or 7 or 8. So this number is fluctuating all the time based on how investors feel on any given day. That causes the value of those businesses to fluctuate based on how investors feel. And this chart by Morgan Housel just illustrates this concept brilliantly. In the short term, the red here is the only thing that matters. The red is changes in the valuation of a company, changes in the price to earnings ratio. But over long periods of time, it's the green that matters. The green is earnings. So in the short term, valuation is all that matters. And in the long term, earnings are all that matters. And these two smart guys named Warren Buffett and Benjamin Graham had this great quote about this concept. They say, in the short term, the market is a voting machine. In the long term, the market is a weighing machine. You should listen to him. That Warren Buffett guy is the third richest person on earth. So why does the stock market go up? Because profits grow over time. And eventually, the price to earnings ratio sorts itself out. Yes, sometimes it's going down. Yes, sometimes it's going up. But over long stretches of time, the market sorts itself out. And if you look at the long-term returns of the S&P 500, the longer your holding period, the more normalized the returns become. So in the 1 year, your returns have fluctuated anywhere between minus 38% and plus 53%. But if you go out 5 years, those numbers converge. And the worst return is 13.5% per year. And the best return is 24% per year. But over 20 and 30-year periods, your return comes to hug the long-term market's return, which is about 10% per year. So that's the concept of why the stock market goes up. But we all know that this can happen. Occasionally, stocks go down hard, and it's very common. Stocks can fall 10% once per year. They fall 20% every 4 years, and they fall 50% a few times a century. So what should you do as an investor? Well, the answer there is continually buy stocks, continually invest in the market, no matter what's happening in the news. Doing so will give you the highest odds of realizing the long-term market's return over time. Now, how can you invest? There's a few primary ways that you can do so. One is mutual funds. Second is index funds. And third is individual stocks. There's pluses and minuses to each of them. The simplest way to invest in the stock market is with index funds. These just buy all the companies that exist on a market, and you will ride the long-term market trend over long periods of time. As to how to get invested, the answer there is to get your money over to a brokerage account. These are the major ones in the United States. I'm sure that in India, there are lots of other brokerage accounts like this that are more than happy to take your money and help you get invested. All right, wrapping up. What do we learn? The US stock market goes up over time, historically about 10% per year. Why? Stocks go up because profits go up. Profits go up because of productivity, inflation, innovation, geographic expansion, and population growth. Now, in the short term, none of that matters. The only thing that matters is the price to earnings ratio and changes in investors' emotions. But in the long term, earnings are all that matter. And if you buy stocks on a regular basis, your odds of doing well in the market go up dramatically. And the odds of you having far more money 10 years, 20 years, 30, and 40 years now from today are incredibly high. Well, thank you. Thank you for watching. If you're interested in connecting with me, there's how to do it. And happy to take any questions that you have.
I already got a question, but I think you've answered that, but I'll still send that to you. Brian just said that the profit drives the stock price of a company, but shouldn't it be the demand of the stock that drives the stock price? I mean, that's why an economic bubble occurs.
Yes, that would be the short term.
You did answer that question via the Warren Buffett and Benjamin Graham quote, but
yes.
Subodhik asks, okay, go on.
I was going to say that's completely true. That gets back to the voting machine question. In the short term, can bubbles form? Absolutely. We've seen numerous cases of that happen throughout history, where investors are willing to pay higher and higher and higher prices for that asset. More often than not, those that are doing so are hoping to sell it to somebody else, as opposed to owning it and caring about the long-term earnings of the company, of the asset. So bubbles absolutely form. And what's happening with the investor demand for any given stock or asset absolutely matters in the short term. But in the long term, the only thing that matters is earnings and earnings growth. And if you buy those assets and they grow their earnings dramatically over long periods of time, you could be pretty darn sure that the value of that asset will go up.
So Himanshu asked us to say that quote again. So I'll just say that It's that in the short term, the market is a voting machine, and in the long term, the market is a weighing machine. And that is what Brian explained right now.
Correct.
Okay.
One of my favorite quotes of all time.
I like that quote too. I read that recently, so that resonated with me. Shubhadeep asks this question: how to calculate the intrinsic value of a stock, and should we invest in a stock with high PE values?
Ooh, that's a detailed question right there. I'll tell you the academic answer. The academic answer is that a stock is worth the future value of all of its cash flows discounted back to the present at some predetermined rate. In essence, you take that business, like my lemonade stand, and you say, here's what the company is going to generate this year, next year, the year after that, the year after that. And then you discount those numbers back to today's price at some predetermined rate. And then that pops up what the value of the business is worth. There are lots of investors out there that do that calculation regularly. That's not something that I do personally. The way that I invest myself is that I try and find the highest quality companies that are on the market, those that I believe will have substantially higher profits 5, 10, and 20 years from now. And I try to add those to my portfolio. Some of the biggest mistakes I've ever made as an investor, the biggest mistakes by far, is finding a great business, liking everything about it, and saying, I'm not buying it. The PE ratio is too high. The price to earnings ratio is too high. I can't buy this. And then that stock goes on to multi-bag. And I missed out on huge gains because I was scared away by the high price to earnings ratio. If you're going to invest in something like a broad-based market, I think you should, or big, mature, boring companies like Pepsi, like Coca-Cola, those companies, the price to earnings ratio and the valuation you pay really matters hugely. If you're going to buy companies that are in hyper growth mode, those that you think could be substantially bigger 5, 10, and 20 years from now, I've learned the hard way, you need to de-emphasize valuation. You should look at valuation, but if you find an awesome company, you should take a small stake in it regardless of the valuation. Because if you're right about that company and the profits are substantially higher 10 years from now, you could be pretty darn sure that asset is going to be worth much more.
Adnan has this question: are markets at overbought situations by looking at the PE ratio?
Right now? Yes.
I'm assuming right now.
Yes. So the PE ratio is mostly an example of showing you why stock prices move on any given time. However, it's one metric. It's a metric. It's the simplest metric that I could use to explain why the stock market goes up. But there are tons of factors that influence what the price to earnings ratio is on any given time. Right now, there's no other place to invest your money. If you look at what the interest rates on savings accounts, the interest rates on bonds, the interest rates on cash, they're extremely low. Because of that, investors that are seeking a return have been forced to go into higher return assets, such as stocks. That forcing function has pushed up the prices of stocks to where they are today. So if you look historically, stocks today are trading at very high valuation multiples. Does that mean we shouldn't invest? Well, I'll counter and say, well, what's your time horizon? If you're investing today because you need the money 40 years from now when you retire, I think it's a great time to put money in the market. And if that's the case, you should be hoping that prices fall. Like if prices fall, you should be rooting to yourself. You shouldn't want prices to go up anymore, because that lets you buy at better and better valuations over time. But to answer your question, are prices high right now? Sure they are. Yes, they are. But that doesn't change anything of what I do, because there are so many factors that influence the short-term valuation that it's really overwhelming for any investor to figure out, well, should I time the market? Should I get out now? Well, you could have said that 6 months ago and you would have missed a tremendous gain. You should have said that 3 years ago and you would have missed a tremendous gain. You could have said that 10 years ago and you would have missed a tremendous gain. So trying to time the market based on what valuation you see is an exercise in futility, in my opinion.
So Himanshu asks, factors to check to evaluate a company. I'd suggest you watch Brian's YouTube channel. He has explained all the factors in a lot of detail. Arindam asks, do we need to learn the concepts of chart study like candle charts and all for long-term investing?
In my opinion, no. There are some traders out there that look at charts and buying patterns and fund flows. And what they're attempting to do is to time the short-term price movements of stocks. That's not at all part of what I do as an investor. My strategy is to buy and hold great businesses for long periods of time. So I don't look at charts, candles, or any of that.
Arbhajoti has a question. S&P 500 takes 500 companies, but in India, the Sensex 30, which is the major index of India, takes 30 companies only. So does it affect our understanding of how the market is actually performing?
That's a great question. I don't know the specifics of the Indian market index that you're talking about, but we have a very similar setup in the United States. In the United States, there are three major indices. The Dow Jones Industrial Average, that one's the best known, the S&P 500, and the NASDAQ Composite. The Dow Jones Industrial Average is just 30 companies. That's it. The whole index is just 30 companies, whereas the S&P 500 is 500 companies. In theory, the S&P 500 is a more accurate index for judging the health of a market. But if you look at the long-term performance of the S&P 500 and the Dow Jones, they are almost mirror images of each other. I don't know if that's a similar case in India, but I can say that my yardstick that I look at is the S&P 500 because I think it gives a better representation of the overall market, and I would assume it's similar for the Indian market.
So Abhishek asks, how important is ROC and free cash flow generation in the American context?
What's the first one? I heard free cash flow. And what was the first?
ROC, return on capital employed.
Oh, return on invested capital. Well, that's a part of my investing philosophy. Between the two, I'll take free cash flow any given time. Free cash flow is a measure of one way to measure the profits that a company generates over time. Another one is net income. You would think that those two things are the same. One's called profits, the other's called free cash flow. Aren't they the same thing? Unfortunately, the answer there is no. The nature of accounting means that those two numbers can be dramatically different for each other. In my investing philosophy, I look at free cash flow. I look at return on invested capital. I look at return on equity. I look at return on assets. And those two things are a part of what I do. So I think that they're important to look at. However, you have to keep the stage that a business is in mind. For example, rewind the clock 10 years ago. Tesla just came public. If you looked at return on invested capital and free cash flow, they would have screamed at you, stay away. Both of those numbers were negative and ugly. And yet, if you bought Tesla 10 years ago, you're up 50-fold. 60, I don't even know, 100-fold at this point, something along those lines. So you have to keep in mind the stage of development that the company is in. If a company is big, mature, and fully optimized for profits, again, Apple, Microsoft, Coca-Cola, those are big, mature companies that are optimized for profit. I think those are great companies to look at free cash flow and return on invested capital. If a company is small, in growth mode, and purposely losing money, those are companies that you can't look at return on invested capital and free cash flow. So it's always about knowing the stage that the company is in and when the metrics are important and when they need to be ignored.
Also, all of you should go through Brian's video on income statement. That will give you a very brief and good idea about financial statements. There are multiple questions on multi-baggers and the metrics you use to identify multi-baggers. And also, did you pick one?
Did I pick
I
one?
think I remember a tweet where you listed out your multi-baggers and potential multi-baggers.
Uh-huh.
So
Yeah, that's an ever-growing list of ones that I think have potential. Sorry, what was the first question?
what are the metrics you look at
Okay,
in
sure.
order to identify a potential multi-bagger?
There's a number of metrics that I look at. I've developed a checklist for myself that any company that I come across, I take it through my checklist, start to bottom, and I always looking at a range of metrics. I'm looking at the financial statements. I'm looking at the balance sheet. I'm looking at the free cash flow statement. I'm looking at the nature of the business itself. I'm looking at the opportunity, the management team. I'm looking at the stock performance. I'm looking at and any risks that I can find, etc. So it's not one thing that I look at. It's a combination of things that I look at, and those combination of things give me a full picture of what stage of growth the company is in, what its long-term potential is, and whether or not I think I should buy it in my portfolio. When I'm actually going to invest, one of the things that I focus on is something called market capitalization. Market capitalization gives you the size of that company's equity, the size of that how much dollar amount the shareholders of that company own. If I find a company that's worth, say, $5 billion, and I think, okay, given what I know about this company today, I could see this business being worth $50 billion in, say, 10 years, I'll buy it. It's a rough calculation that I do where I do a gut check for myself, and I say, can this thing go up 10 times in value? If the answer is yes, I'll buy it. If that same gut check finds a company that's worth $10 billion, and I think, well, if all goes well, this will be a $15 billion company in 5 years, I'll pass. I'm not going to risk my capital for what I conceive to be a 50% return. So when I'm looking for investments to make, I'm asking myself, what are the highest quality companies that I could find? How much could I make if I'm right? And how much can I lose if I'm wrong? And I try and find the most favorable combination of those things.
Yeah, Brian, I had one question. I asked you the question about the free cash flow. So like we have options in India to invest in US companies, and I do it, like I do my research on that. The problem here is like certain growth companies in the form of Coinbase or let's say Shopify, like they are just starting out, that I understand well. But what are those factors you are looking at when you are trying to analyze, the growth companies and not the companies who have already reached the valuation point or are mega caps? I'm talking about growth companies over here.
Yep. The formula that I use is the same. My style of investing primarily focuses on dynamic, high growth businesses. Those are the kind that I'm attracted to. And it's a combination of quantitative and qualitative factors. For example, management, the quality of a management team matters a great deal. Well, show me the number that says this company has a great management team and this one has a terrible management team. There are things that you can look at that suggest whether or not that management team is high quality or not, but that's a qualitative factor, and that matters a lot to the business. Another thing that I look for is something called optionality. That's the ability of a company to open up new revenue and new sales opportunities for itself over time. There's no metric that shows you, oh, this company has optionality, this company doesn't. So that's just the kind of things that you have to get a feel for as you go through and learn about a business. But it doesn't matter to me whether the business is a growth business or a value business, a mature business or a young business. I look at the same metrics on all those companies. And what I'm trying to find is the highest quality companies that I can find. And that's where I put my capital.
Right. Just one more question here. So with respect to, availability of information, we are quite limited to that. And like there is a certain sense to diversify in the foreign assets as well. So I'm just asking you as a personal opinion, although the fact is that we can't, research so deeply into stocks. So how is the ETFs working out in the American context? Like I have seen about Vanguard ETFs and ARK ETFs. So how are those as an alternative to not go with these direct stocks and invest in the ETFs for someone who is trying? For someone who is trying to diversify.
Exchange traded funds, or ETFs, are a semi-relative innovation in the financial markets, and they're kind of like hybrids between stocks and mutual funds. So they are buyable on an exchange, that are listed on an exchange. You named a couple of there, and by buying these one fund, you gain access to whatever that fund holds, and that fund could hold dozens of stocks, all kind of amalgamated together in one fund. I think exchange traded funds are a fantastic way for investors to get exposure to markets that they want. To your point, if you don't have the time, inclination, or desire to research companies on an individual basis, I'm a huge fan of just putting your money into broad-based index funds or exchange traded funds and keeping your capital there. That greatly reduces the amount of individual stock risk that you're taking, and it also allows you to get the upside from a theme or an asset class if it works out over time. So in general, ETFs, I'm a big fan.
All right, that helps. Thank you.
There's a question. Sir, is the valuation of Tesla legit, especially if we take into account the regulatory tax credits?
Is the valuation of Tesla legit?
Yeah.
Depends on who you ask. Tesla is one of the hardest companies that I've ever found to value. Period. What is the future of Tesla? In 2030, 10 years from now, I could see Tesla being the largest company on earth. I could also see it being bankrupt. Like that is the range of outcomes that are available to investors right now. Let me ask you this question for those of you that follow Tesla closely. 2 weeks ago, they announced that they were getting into the robotics space, the Tesla bot. Okay, what's that worth? What's that worth today? I don't know. The answer is it could be worth hundreds of billions of dollars, or it could be worth zero. How do you value that? How do you look at that and say, here's what that's going to add to the value of the company? Tesla is incredibly hard to value. If you are a value investor, they've been screaming this for years. Tesla only sold 50,000, 100,000 cars. Fill in the number. Well, Ford, GM sold millions of cars. How could Tesla be bigger than Ford? It makes no sense. That's the market's way of looking forward and saying, we think Tesla is going to grow and take market share for years and years and years. And we think that Ford, GM, and everyone else is going to lose market share for years and years and years. Well, that's what the price of Tesla is telling us today. Is that right? Do you think that Elon Musk's is correct? Well, if you look at his track record, he has a pretty good history of being correct. But Tesla it's a stock that if you try and value using traditional metrics, you're going to pull your hair out. It's just too hard. It's very much a bet on Tesla is very much a bet on Elon is right and everybody else is wrong. And so far, that's been a pretty good bet. By the way, Tesla is my second largest holding personally.
Oh.
I mean, haven't they factored in a lot of good things about Tesla in terms of future? Like if you see the P ratio, that's not making it's quite large in terms of the P ratio. So
yep.
Haven't people factored in a lot of good things which can already happen and is being factored in the price today? Or are they expecting more?
They certainly have. Tesla is factored in. A whole bunch of goodness is factored into Tesla's stock price today. But my investing style has learned this the hard way. The greatest companies on the markets, the absolute greatest ones, have very high expectations that they hugely exceed. They have huge expectations and they blow away those high expectations. Look at Amazon. In 1999, Amazon stock was unbelievably high. It was up several hundred times in value since it came public. And there were people screaming, this makes no sense. This means that Amazon is going to grow at a 30% rate for 20 years. That's not possible. And what happened next? Well, Amazon stock got taken to the woodshed and went down 90%. But Amazon in 1999, even if you bought at the absolute high, the worst possible time, you're currently up 20-fold from 1999. If you bought Amazon at the worst possible time, you're up 20-fold. Now you had to stomach a 90% decline to get there, but that just shows that the rare companies like Amazon have ridiculously high expectations that they outperform. But it's really challenging thing to do, to look at a company that's trading at a nosebleed valuation and say, I'm going to buy it. It's really, really hard to do. And that investing style just doesn't appeal to a whole lot of investors. For me, I invested in Tesla 9 years ago. I invested a small amount of my capital, and that is taking that risk is hugely paid off. And I personally believe that Tesla will be the largest company in the world someday. I think it could multi-bag even from up here. But is that right? We'll find out. I fully accept that I could be extremely wrong, and that stock could go down 70% from where it is today.
No, I think the way Elon Musk handles his Twitter, it won't happen.
We'll see. Either way, it's the most fun company to follow I've ever found.
Definitely. It's like it has got a crazy fan following.
Yeah.
And the sarcasm level is damn too high for them.
Your voice is breaking.
Okay, sure. Go on, Pranay.
There's one question. Do you use scripting tools in order to find hidden data? Scripting or scraping tools?
Nope. All the data that I find is freely available in SEC documents, management presentations. I have zero information edge, zero. But the good news is I don't need it. We as individual investors don't need any information edge because we have the greatest edge that you could possibly have, which is patience. Most professional investors do not have the ability to buy and hold. They don't have that ability. Not because they don't know they shouldn't buy and hold, but because their clients don't let them. It doesn't matter if you're a mutual fund manager and let's say you're really high on a stock. Let's say you're really high on Netflix in 2012. And then news comes out that Netflix is launching this new service called Quickster, and it's splitting its offerings into two. For those of you that were invested in Netflix at that time, as I was, the stock went down 90%. 90% from that announcement. Do you think that's fun to have that in your portfolio and explain to your clients, oh, we like Netflix for the long term? Sure, it's down 90%, but we still like it a lot. No, you get fired. You get fired if that was your largest position. You would underperform so horrifically that your clients would be screaming at you. Because of that, most professional managers have to take a short-term mindset with the market. They invest for 3 months, 6 months, 1 year, or maybe 18 months. As an individual investor, I don't have any clients to report to. I report to myself. So I can buy a company and hold it for 5, 10, 15 years. That's my edge. That's it. The ability to be patient. But it's a massive edge. So I don't have an information edge. I don't have a market timing edge. None of that. My edge is patience.
Arindam asks, you told your second largest holding is Tesla. What is the first one, if you're willing to tell?
My first one is a company called Mercado Libre. The ticker symbol there is MELI. That is the Amazon of Latin America. So they are an e-commerce platform that connects buyers and sellers. It's kind of like a combination of eBay, Amazon, PayPal, Craigslist, all those amalgamated together and put that in Latin America. Importantly, my investing style is to buy companies and then do nothing. So I didn't go out and say, I'm going to make Tesla my number 2 holding and I'm going to make Mercado Libre my number 1 holding. That wasn't my intention. Those companies became my number 1 and my number 2 holdings because their stocks went up so much. So I didn't pick those companies. The market did.
Right.
We don't have any more questions right now.
Yeah,
We'll
Brian,
wait for another. Yeah, okay.
Brian, just a second. Brian, I had one question. Obviously, you were a writer at Motley Fools. So taking this excerpt from the Benjamin Graham Intelligent Investor, there's a paragraph where they talk about the foolish four. In mid 1990s, Motley Fool it got first out on the Motley Fool website. The Foolish Four. I'm just asking, this is obviously unrelated. What is your opinion on that particular the Foolish Four thing which came out?
In the 1990s, if memory serves, the Foolish Four was they would took the 5 worst performing Dow Jones Industrial Average stocks. They would eliminate the last one, and then they would buy the next 4. And studies showed that those 4 stocks would then go on to outperform. If you follow the people that came up with that were David Gardner and Tom Gardner, and they abandoned that strategy in the early 2000s. They showed that it stopped working. So that their investing style has changed dramatically since the 1990s. So I wouldn't look at anything that they said in the 1990s or even the early 2000s and be like, that's their style today, because their style has morphed a lot. But to answer your question, I have not looked at that strategy since 10 years. So I have no idea if it works or anything like that.
Right. Just one last question. I try to do my research on those companies. So there are certain websites like Yahoo Finance. We have different websites very much catering to the Indian context. So what are those certain like websites in the American context which we can look at for doing research on certain companies? Yahoo Finance is there, Motley Fool and Morningstar is there. But in terms of equities and stocks, if I have to look at, what are some good resources?
I quite literally made a video 2 weeks ago called 20 free investing resources that anybody can use. So you can go check that out. But off the top of my head, I will tell you that my top free resources, number one is the SEC database. That's the Security and Exchange Commission. That's where all companies are required to publish their financial documents. And that is a treasure trove of free information for investors to look through. Number two would be the companies themselves. Google any company and then investor relations. That will take you to all their SEC filings, investor presentations, conference calls, etc. I also use Yahoo. I also use a website called FinViz, which is a screening tool. There's a wonderful tool called Ticker, TIKR, that has lots and lots of free data that's easily accessible. So there are tons of tools out there. But seriously, check out my video. I list 20 free resources for you.
Sure. I'll check that out. Thank you.
There's one last question. How to know this is the max a stock can reach?
Yeah, that would be a gut feel for you, and just kind of asking yourself questions about the business, the nature of the business. So if let's say it's a company that comes out and they specialize in pet insurance, right? Most of the time, those management teams will give you some projections about here is the size of the market. And that will be done by what's their average selling price times how many pets are available in their market. Well, that's the market opportunity for them. You as the investor have to then say, well, of course, they're not going to get 100% of the pets covered. Maybe if this company is really successful, they could get 5%. And then you do the math on that and be like, okay, that's their current sales potential. What would their profits be on that level of sales potential? And what would investors be willing to pay for those profits? And coming up with a rough number for what you think the company could grow into in time is perfectly fine. So I always like to think just whatever the current market valuation is, add a zero on the end. If you find a company that's worth $5 billion, add a zero and ask, if this company is successful, could it be worth $50 billion? And just do a gut check on that. And then go and check some other companies that are worth $50 billion and say, all right, is this idea as big as CrowdStrike, for example? And that's just one way to think about it. The only other caveat I'll throw in there is your gut feel is going to be wrong. It's just going to be wrong. But I would rather have a gut check like that, knowing that it's going to be even if I'm in the ballpark, that'll be helpful. So that's the way that I think about it.
I'll take just one last question because I don't understand anything about this question. There's a potential inclusion of India in the Morgan Stanley Global Bond Index in 2022. So what does this mean for the economy as well as the investors?
No clue. That's a macro question. And that's a specific question there that I can't offer any value to say. Can't help you on that one.
Okay, I'll ask everybody to switch on their camera so that we can have a screenshot of this meet and we'll post it on our social medias. So everybody, please switch on your cameras. Okay. Yeah, people are switching on their cameras eventually.
Yeah, so on a count of 3, we can actually have a CHE's kind of moment, right? With Brian, of course. So I'll just count to 3 and 3, 2, and 1. Got it. The screenshot is captured, right? Great then. And Pranay, you can go on.
Thank you so much, Brian, for taking out time from your busy schedule and conducting this talk. I want to urge all the participants here to follow Brian's Twitter and YouTube pages. There's a lot to learn from him and a lot to learn about long-term investing. That's all from us tonight, and it's evening here in India, Brian. So that's all from us tonight. Thank you everybody for participating. We'll see you again soon. Thank you, Brian, so much.
Thanks very much for having me. Had a great time.
Thank you.
We too. Thank you so much.